Good afternoon, everyone. And just a little bit about myself. Basically, I've been in the market for many years, 20 years exactly. And as you can see, I am a technical analyst and a professional trader. And I've been working with hedge funds as well. I am a member of the Society of Technical Analysts, MSTA, and I have the investment management certificate. Mainly, I think I also combine some fundamental analysis to my work. So it's not just technical, but I would say mainly technical, based on Elliot Wave analysis. Elliot Wave analysis has been around for many years. It's not new. But I think that the majority of traders, they don't use Elliot Wave analysis. So today, what I wanted to do today was to tell you a bit more about Elliot Wave analysis, how to use it to forecast the market, and I was going also to talk about a low risk strategy based on Elliot Wave analysis. The first thing you need to ask yourself is what kind of trader you are, because depending on your thinking and how active you are during the day, you could be a day trader, you could be a swing trader. A day trader, for example, as you know, I'm sure you know, they are very, very, very busy watching the market. So do you have the time to do that? The other thing about day trading is people use a very tight stop loss. I think it's not the best. Not the best because if a stop loss is tight, it's got a greater chance to be hit. For example, the market will go up, but it won't go up in a straight line. The market will make higher high, higher lows, higher highs, higher lows, and those movements up and down within an uptrend can hit the stop loss if the stop loss is too tight. So this is why it's difficult to make money from day trading. Swing traders, for example, have a better chance of making a profit. Why? Because the stop loss is wider. So less chance to be hit. And then you've got position traders or even fund managers who invest for the long term. And those people, they don't have a stop loss. And the reason they don't have a stop loss is because they know what the stop loss does to your account. So if you are a long-term investor, like a fund manager buying stocks, they just buy stocks and hold them for months or maybe for years without a stop loss. And that seems to work. Obviously, they don't make a very high return, but it works. So first you have to define what kind of trader you are, because that will impact your result in the long term. As I said, day trading is more difficult than swing trading. And then you've got the type of analysis you can use, fundamental analysis or technical analysis. Then you have to decide on your risk preference. Again, this is to do with managing your fund so that you don't lose your whole money. You've got some low-risk strategies and some high-risk strategies. The reason why I mentioned that is because, in general, when I talk to people, people are always keen to make the maximum they can. This is what a trader is like. A trader wants to make a lot. If I go to somebody, a day trader, and I tell them I've got a strategy that will make you 10% per year, they are not interested. They are not interested because they are looking at 100, 200% return. But of course, not many people can do that. So if I look at the two different kind of strategies, the low-risk strategies, it's one where your fund is going to be stable over time, no large drawdown. But if you have a low risk strategy, your return will be maybe 20% per annum. That's still good. 20% is very good, compared to what people get in a bank or what a fund manager will do over a year. So it's still good. But as I said, many people have high expectations. They want to make more than 20%. And in order to achieve that, you need to take more risk. Okay, you need to go to a high risk strategy where you can double your money over a year. But of course, that kind of return will be achieved with some large drawdowns in your account. If you don't mind seeing your fund going down 20 or 30%, and then you're doubling your money over a year, then that's fine. The high risk strategy is for you. But in general, what I found when I talk to people is that they want to make a very high return, like maybe 100%, but they don't want their account to go down, and that is not possible. You have to be realistic, So I have two strategies. One is high risk for my clients, and one is low risk. And the one I prefer myself is a low risk one. That is the one I'm going to discuss today. If you think again about a fund manager, fund managers, they don't take high risk. And the reason is because they are not happy to see their fund go down 20%, even if it's temporary. It doesn't matter. They won't be happy about that. And this is why they adopt a very low risk strategy. It's not because of them personally, it's just because of their clients. You can imagine many clients would just pull out their fund if it was done 20%. Now, when I talk about risk, also the other thing is some people maybe will risk 2% or 3% on one trade. I think you can go up to 4%. You can risk 4% of your fund on one trade. In my experience, it's worked okay. So, for example, if you have like 4,000 pounds in your trading account, your maximum loss on one trade is 160 pounds. So I'm talking here about spread betting. Okay, so if you have 4,000 in your account and you make a trade and it goes wrong, then your maximum loss should be 4%, which is 160 pounds. So if you are using now 80-point stop loss, that is equivalent to betting 2 pounds per point. Okay, so in this example, you shouldn't bet more than 2 pounds a point to keep to the 4% maximum loss. So the thing here is that if you are going to do a high risk strategy like maybe day trading, you need to be able to accept those temporary losses, and then you move forward. If you can't accept those losses, then it's no point to trade. You have to do something else, because risk and return, they go together. High risk, high return; low risk, low return. You must decide. So some of the pitfalls to avoid, and I've already discussed some of them, like don't bet too much. I was referring to the 4% maximum loss, because as you know, betting too much, is dangerous. At any time, sometime in the future, you could go through a bad run, and then if you bet too much, you lose your money, and then you can't trade anymore. All those pitfalls listed here, I'm sure you've read about them already, or you've heard speakers talking about them. It's all common sense. Don't trade against the trend, for example. And also do not be tempted to trade if the conditions are not right. I'm talking about if you see something in the market and it doesn't make sense. What I mean is, you know, your system or your strategy is telling you the market is going to go up and it's going down for some bizarre reasons, then don't trade because there is something that is not right. You know, you have to remember that there is always another opportunity to open a trade. Discipline and patience, they are very important because discipline, if your system is telling you something and you don't do it, then you're not disciplined. You can't win if you're not disciplined. And the patience also, patience is important because sometimes a move will take time to develop. So if you're not patient, you may be right on the direction of the market, but if you're not patient, you're not going to capitalize on that move because you may close that position early. So you need to be patient, you need to be disciplined, and you need to understand that losing is part of the game. Because, as I said, there is always a period where things will not go the way you want. And it's nothing to do with your strategy. It's nothing to do with your discipline. It's nothing to do with all the things you've learned. It's to do with the unexpected, like the central banks, like the economic data, like the politicians. They will, at some times, they will make some very important announcement that will move the market. And whether or not your strategy is telling you it's going up, once they tell you that news, the market may go down. It may go the opposite way. So this is why, because the market is driven by the news, we cannot be sure that it's going to go the way we want. The other thing is that sometimes you can go into a period where there is a lot of news, and that news will go against you for maybe longer than expected. And if you are betting too much, for example, and you take a series of losses, then you can lose your money, and then you don't have any more money to trade. So this is why it's important not to bet too much. And also the other thing is don't chase the market. I mean, some people like to buy on breakout. I don't think a breakout is a good way of buying the market because when a breakout occurs, it's already too late. The move is underway and it's going. So what I tend to do is I tend to buy low and to sell high. So for example, if we get a pullback, I will buy. And when the market goes up and rallies, and then I will sell. Okay. So as I said, I'm going to go through a winning strategy, which is using Elliot Wave analysis. It's low risk. It uses momentum and timing indicators, and also hedging. Hedging means protecting some of your position with other positions. The technique I use is Elliot Wave, and Elliot Wave is the way, I mean, it's the way the market moves. And when I say the market, I'm not talking about just the stock market, but I'm talking about the currencies, like any currency, like euro, dollar, cable, also gold, commodities, bond, anything really, anything that people trade. And the basic pattern is shown on that slide. You can see the market move up in 5 waves, and then it goes down in 3 waves, ABC. Now this pattern, when the market goes up in 5 waves, that is a bull market. Okay, so when you are in a bull market, you will see that the market move up in 5 waves and goes down in 3 waves. When we are in a bear market, it's the opposite situation. In the bear market, the market will go down in 5 waves and go up in 3 waves. So remember, this is important. Okay, when bull market, they move up in 5 waves. Bear market, move down in 5 waves. Okay. This Elliot wave was discovered by an accountant in the 30s. His name is Ralph Nelson Elliot. And he was also a stock market analyst. And he discovered this repetitive pattern. And that pattern takes the same shape in different time periods. For example, on a monthly chart, on a weekly chart, on a daily chart, and even on a 5 or 10 minutes chart. So you've got this same pattern occurring, in different time periods. And the way the market move in 5 and 3 is to do with market psychology. The way people behave in the market. But of course, if you look at the chart, it's not always clear that it's moving up in 5 waves. There are some variations, so it's not as simple as that. When I say 5 up, 3 down, this is a basic pattern. There are many other variations, and I'm going to show you some of them later. So it's not very simple like 5 and 3. Otherwise, everybody would do it. But we can see here an example that history repeating itself. And that is in the S&P. In 2006, you've got a pattern that occurred in the stock market. And that same pattern occurred again in 2010 or after 2010. And if you look at it's very, very similar. Very similar. First, going back to the left of the chart, we see that the S&P moved up in 5 waves. You can see on that red line, 1, 2, 3, 4, and 5. Okay, 1, 2, 3, 4, 5. Then we get a sharp pullback to that support line here. Then the market made a new high, back another test to that trend line, lower high, and then a breakout. Okay, bearish breakout. And if you look at the pattern in 2010, it's exactly the same. You got 1, 2, 3, 4, 5. So an Elliott wave in progress in 5 waves, pull back to the trend line, a rally to new high, a back test again, trend line, lower high, and breakout. So this is a very good example showing you that the pattern not only follow the Elliott wave, I mean the market not only follow the Elliott wave, but also repeats itself over time. Elliott wave analysis is very useful, and I think it's the best market analysis there is. It's accurate, and I will show you why. This recurring pattern of 5 up and 3 down occurs at different time periods, as I have said, and you can see on that chart here, on the right chart, the first wave is also in 5 wave, and the second wave is in 3, ABC. So that global pattern, I mean, larger pattern that you have from the start of the move to the top here, which is wave 1 in bracket, is in 5 wave, but each wave up is in 5, as you can see, and each wave down is in 3, ABC, ABC. So wave 2 is in ABC, wave 4 in ABC. Then we get to the top, the trend turns down, and this time we are into wave 2 in bracket, and that one is in 3 wave because it's counter trend, but this time, because the trend has turned down, the first leg down is in 5 wave, the second up is in 3 ABC, and the third one down is in 5 wave as well. Okay, so this is how it works. This is the basic pattern. Now, for example, if I was going into, for example, wave 1 in bracket, I don't know if you can see that one. It's wave 1 in bracket, that one, yeah. The first decline is wave A. Now, if that was like a daily chart, okay, and I was zooming in on that move, that wave A on a, like say, maybe a 30 minutes chart, that wave A would be in 5 wave as well. Okay, so the pattern repeats itself. Now, why do we have 5 waves? And many people have speculated on the reason why. Some people have come with different answers, but one of the most credible answer is that is to do with the psychology and the way people buy and sell in the market, because you have to remember that when we're at the bottom of that 5 wave rally here, what was before that bottom here was a downtrend. So the market was going down. It was going down, and then it started 1, 2, 3, 4, 5 going up. Okay, so at that stage here, at the bottom of the first wave, you can imagine that people are pessimistic because the market has been going down. In general, what you find is that at the bottom of the first wave, there is an increased level of pessimism. Okay, so whether it's like a 30 minutes chart, a 1 hour chart, a daily chart, it's the same thing, except that if you are looking at the stock market like a long-term chart, like say a weekly chart, at the bottom of the first wave, stocks are undervalued. This is what would happen normally, because you had a big correction, so everything is undervalued. Sentiment is negative, and this is where the rally starts. The rally starts, when no one expected, or not many people expected. So you get that first wave up, going up. Is what we call a rebound from oversold condition. And also, there may be some very like astute investors, and they will start buying also because they know what's happening. Then you get the second wave down, which is a normal correction. Okay, and in general, that second wave down is very deep. It's very deep. The reason why it's deep is because the majority of traders or investors thinks that the previous downtrend is still intact. This thing is going lower, okay? And this is why that second wave goes far. In general, that second wave will retrace maybe 50% to 100% of the first wave. So if you are trading Elliot Wave and you know that this is a wave 1 and you want to buy because you want to catch wave 3, you want to buy wave 2 when it's very low, basically. You don't want to buy too early because wave 2 tends to go like much lower, more than 50% of wave 1. So this is what I would do. I would wait for wave 2 to go down very much before I start buying. And then when the wave 3 starts, so that is the next wave up, and the price breaks into new high, this is when people realize it's not going down anymore, you see? And this is why that wave 3 is very powerful. It's one of the most powerful wave in the 5 wave sequence. It's because there is increased participation at that stage. People realize it's going up now, it's not going down anymore. And if we are looking at the stock market, like again on a weekly chart, in general, the business news improves as well. So you get better economic data during that phase. It's just the psychology of people. If a market changes direction, they are quick to react and to buy. And this is why they push that wave 3 very high. This is why that wave 3 is powerful. Then we get the fourth wave down, and that one in general is not very deep. So unlike wave 2, wave 4 is not deep. And the reason why wave 4 is not deep is because people have realized the trend has turned up. So they are not going to let the price drop much now. And that's the reason why wave 4 is not deep. And very often, that wave 4 will go sideways. And again, sideways is like, like a triangle, for example. And the reason why it goes sideways is, again, because there is a lot of people buying. Many people are buying because they realize the trend has turned up. Okay, so that is a sign that is when it goes sideways. And then after wave 4, what we get is a final wave up, which is the fifth wave, wave 5. And that one can be powerful as well, because you can imagine that there is even more people on board thinking the market is going up. And the irony is that it's like when there are too many people bullish that the trend, the market just doesn't go higher. The trend turns down, and this is what happened after the fifth wave. So during that fifth wave up, there is an increased participation, increased optimism, and the way that the market behaves at that stage is that it will make new high, but the technical indicator, like for example, momentum indicator like the MACD, RSI, all those indicators will start making bearish divergence. What I mean by that is that the market is making new high. There is many bulls, more than at the bottom of the first wave, and the technical indicators are weak. They are not making new high. Like the MACD will make lower high. Okay, so as you can see, it's much more based on investors' psychology, because at the bottom of the first wave, maybe we had like very few bulls, like maybe 20% bulls and 80% bears. And at the top of the fifth wave, in general, you have the opposite situation where you have only 20% bear and 80% of bulls. So it's a complete opposite scenario. And how do we know that we are at the end of the fifth wave? Because it's not just, like I said earlier, it's not straightforward 5. Sometimes the pattern is a bit different. It's like what we call a variation, okay? And I'm going to show you how. I've already mentioned the weak technical indicator, like the MACD, for example. That MACD on that chart, you can see what I was talking about, because here, you've got 5 waves done here, okay? 1, 2, 3, 4, 5. But if you look at the MACD, at the bottom of the fifth wave, that MACD is higher. This is what I call like a bullish divergence in that case. Bullish because the MACD is signaling that the market will rally. This is why it's making a higher low. And you can see that sequence done before we were in a bear market, and this is why the decline is in 5 waves. It's in the direction of the market. When the market is bearish, declines are in 5 waves. And you can see that the MACD, the lowest point in the MACD was on the third wave. Okay, so the third wave is very powerful. This is what the third wave has driven the MACD to a record low. But then, when the fifth wave goes down, you can see the fifth one is lower. It's making new low, the fifth wave, but not the MACD. The MACD is higher low. Okay, it's telling us that the trend is about to turn up because we've got 5 waves down. Okay, and that divergence is very common. Now, if I go to look at the chart, I'm going to go to my platform, and you can see that this is a FTSE chart here, the one on the left, and I've put all the labels on that chart. It may look a bit complicated, but it's just to show you that what I was saying about how Elliot Wave is a very accurate way of looking at the market, because this is the way the market moves. The market follows an Elliot Wave pattern, whether it's a FTSE or gold or whatever. I mean, some markets are more difficult, like maybe gold. I just mentioned gold, but I find it more difficult to interpret the Elliott wave on gold. But on the FTSE, it's very good. And you can see that if I go back to April, that was the bottom of the fourth wave here. You can see wave 4. We were in a bull market, of course. And because it's a bull market, each rally is in 5 waves. And you can see, if I look at from the bottom of wave 4 to the top so 5 wave up inside wave 5. Now I look at again with 5 wave inside it. 1, 2 in bracket, and 5. And this is a 90 minutes chart. Okay. So is in 5 wave.
Hello, everybody. Yes, I think we're experiencing some audio issues. Hopefully, you can hear me, but I'm losing Thierry. I don't know if you can hear me, but we're losing you, I'm afraid.
You are losing me?
Oh, okay.
Hello?
Yes.
Are you losing me?
You're sounding stronger now.
Okay. Okay.
Okay.
Is that better?
That sounds better. It just sounded like the signal was getting weaker earlier there. Okay, so sorry, let's go back and keep our fingers crossed.
Okay. Okay, so I'm saying that markets here is moving in 5 ways.
No, Thierry, I don't know if you can hear me now. We are losing you again. I wonder if perhaps you could close down something. It might be the platform that's using up your bandwidth. Is there something else maybe you can turn off?
Let me change microphone to see. Hold on. Can you hear me?
Yes. Okay, that sounds good.
Is it better?
I think that's better. Yes, I think would everybody agree that's a little better?
Okay. Oh. So have you? I don't know where the people if they heard what I said about that specific wave.
Okay.
Wave 5.
Thierry, I think the problem is not the microphone. If you can hear me, I think the problem is the bandwidth. I think you might have something running in the background on your computer that's using up the internet bandwidth, and that will be causing this cutting out that we're hearing.
Yes.
If there's something else, if there's any other applications that you can close, that might help. It just seems to have started in the last 5 minutes, which is strange.
I don't see anything running on my computer because I just have some browsers open this platform, but it's not updated. You know?
Okay.
So
well,
I'm not sure. I can close a few things, and you tell me. You know, if you hear better.
Okay. We're still getting a little bit interference, but let us just try. We'll keep our fingers crossed.
Okay. Okay. Fine.
If we could go back to the FTSE chart and just start again with describing the FTSE chart, there, that would be great.
Yes. Okay. So what I was saying that wave 5 in that chart, 5 waves. So we will circle. Okay, so that moves in 5 waves, and if like one circle is also 5 waves, 1, 3, 5. Where this circle, that one also in 5. 1, 2, 3, 4, 5. And then the 5th wave, 5 circle is also in 5 wave. 1, 2,
3, 4, 5. Okay, so you can see that each wave up is in 5 waves, and because of that, I was able to anticipate a top, and that was at the end of May, because I knew the market was coming to an end. I mean, the rally was coming to an end. The only variation we've got here is that the shape of that which is 1, 2, 3, 4 is called an expanding diagonal. And that is a variation, because normally the market moves like we call it impulse, means that okay, it's a bit like some variation. This is, it's not straightforward, Elliot Wave, but you can see from that chart that if you are an Elliot Wave analyst, you would have expected a top at the end of May. Now, if I go to my report, because I was telling you that not only I look at the Elliot Wave, but I also look at some indicator to help me with timing the end of an Elliot Wave. So if I go to the chart, for example, that was a report I've written on 1st of June, and when you join my e-yield traders community, which is where I publish my trade and the strategy, the low risk strategy, you will get this report as well. So you will be able to read that report every day. And you can see that on the 1st of June, that was my wave count. You can see I was calling for a rally to yeah, it says 76.20 as well. The top was at 76. So I wasn't far from the top. And then I predicted a decline to that area near 73.50, which I think we went near that level. So all that was because we had a 5-wave pattern, okay, and that pattern was complete, because as I said, after 5 waves it should go down in 3 waves. Or if it's a bear market, like maybe we are in a bear market, it's going to be 5 wave down. So at the moment, I'm waiting for more confirmation from the market to see if we are in a bear market. But in any case, after 5 wave up, it should go down, and it went down. So now I'm looking at some indicators on that market, because on that report, because if you look at those indicators here, the timing indicators are very important, like that 34-day BTI. You see, that 34-day BTI is bearish. So on that day, 1st of June, it was bearish. And that means that there is a high probability that the market will decline for many weeks. That indicator, 34-day BTI, is called a trend reversal indicator. And when it becomes overbought, it means that the market will experience a multi-week decline. When I say multi-week, it could be 2 weeks, it could be 3 or 4 weeks or more. So at the moment, it's been going down for 3 weeks already. So again, the combination of that indicator telling me that the market is going to turn down and a completed Elliott wave in 5 waves was enough to go short. So if you are a swing trader, you can take a short and sit with that short for many days, or if you are a day trader, you can use the direction, because now you know it's going down, so you can in at, shorting, closing, you can follow that trend. But this is the way I use it, and again, when you join if you join my e-yield traders community, you will have this report every morning before the market open, but also in the app, in the traders community, you can chat with me. Okay, so basically, what is it? The e-yield traders community. The e-yield traders community is a messaging app. Okay, it's a bit like Messenger, except that it's bespoke and is secure. And in that community, I discuss the markets, exchange ideas with people. I send my latest updates. People ask questions, so I answer their questions. And I also publish my threads about this strategy I was telling you. And the strategy I run for the community is a long-short FTSE cash future and options. So this is not day trading. This is more like swing trading. It means that when I take a position, in general, I keep it for many days, maybe 3, 4, 5 days. Sometimes I will do a trade like I did this morning. I bought the FTSE just that is like an intraday trade. Okay, so I bought it this morning to close it later. I won't keep it more than a day, that one. But if I show you the app, like I said, it's an app, a messaging app. You can go to the App Store to download it. It works on the iPhone, it works on the Android phone, and also on desktop. So from your computer, you can chat to me. And this is the app. So as you can see, it's called the Eagle Traders Community. This is one group where people ask questions or I chat to them. I give them my view market. I will post chat more. Also, I post my trades, but those trades are posted in a different group, which is called Thierry's Trade. So you can at the top, you can select the group you want. Here, for example, I can go to Thierry's Trade. So all my trades are posted in that group. If I want to chat to people, I go back to the traders community and I just post my message here. Okay, so for example, if I go to my trades, you can see this is what the strategy is about. It's like a mix of position between, for example, I'm short FTSE cash, long FTSE September, short on calls and long on calls. Okay, a call option. This is what I mean. I mean, if you don't know, never traded call options, I will explain everything when you join the community. I send people some information about how to use options. And also, if they need some help, they don't understand something, they cannot always ring me, and I'm always available to help them. If you don't understand something, please give me a call and I will explain.
Thierry, we've just got about 10 minutes left. Could we answer one or two questions which are waiting?
Yes.
Yeah, okay. If you, I'm looking at a question from Marvino. He says the EW issue equals wave count ambiguity. If you show the same price chart to 5 Elliot Wave analysts, you will probably get several different wave counts. That ties in with Alan's question again as well, where he says the difficulty in using Elliot Wave is defining the swing high and low. Each person, it might be different for each person.
Yes, I agree.
Yeah, how do you sort of deal with that?
Well, I deal with that. I'm not saying that I'm right all the time. Of course, I'm not. Like any other Elliot Wave analyst. But what we need to do is first look at the pattern and I use my own indicators to confirm this. Okay, for example, I was showing on the report earlier that report that when that 34-day BTI was bearish, it means overbought. I knew we were near the top. Okay, so for example, when I saw that move down here, I can't see. I have to go to my software. Okay, so expand. I knew it was an expanding diagonal. So that wave up here occurred when that indicator was overbought, which was a strong signal that we were at the top, at the end of that move up. But I think that in that example, it's quite easy because any Elliot Wave analysis see that so I think there is no ambiguity here. But I agree with the person who asked the question. Sometimes there is you can have two analysts and they both have different view because of their wave counts. They have different wave counts. That's possible.
Okay. Tina says, what about the Elliott Wave show? What does it show for the Nasdaq at the moment? Do you have?
No, I don't look at the Nasdaq.
Don't. Okay. We'll move on from there. Marguerite says, what is the longest fifth wave you've encountered?
The longest? I can't remember the longest, but yes, sometimes a fifth wave can extend.
So they can go on.
That makes it more complicated when there is an extension. Sorry?
Yes, they can go on for long.
Yes, for example, if the fifth wave extends, then it's possible that you will be. I mean, if the market is going up and the fifth wave extends, then it's possible that you will go short too early because of that extension, and there is not much we can do when that happens, because it's just the way there is no indicator that can tell you in advance that the wave will extend.
Can you remind us, Richard's asking, what the initials BTI stand for in that report that you have?
BTI is my own indicator, so this is why you won't see it anywhere else, and it's called a bullish trend indicator.
A bullish trend indicator. There we are.
For example, when that BTI is bullish, like it is here, it gives you what it does is like a directional indicator. That BTI normally is in the same direction than the trend in the market. So when that is bullish, it means it's likely that the market will go up in 5 waves, basically. And when it's bearish, it's likely that the market will decline. Basically, it's like tracking the market movement. This is what it does.
Got you. So you'll learn more about that, obviously, in your community. That'll be one of the things that you'll have access to.
Yes. So basically, I was talking about the community and that app, and basically people get they get all the report, and they get all the communication with me, like chatting with me during the day live, So they get my forecast any time of the day. If something changes, then I will post it on the app.
Fantastic. That's
great. With regard to the strategy, with regard to the strategy, as I said, what people do, they copy my trade. This is what they do. Because what I will say to them, like for example, that trade 1/3. You see 1/3. It means that is a very, very small trade. Like normally I tell people to bet £1 per 1,000 pounds in their account. So I give them all the instructions so they don't lose their money, but because that strategy is very safe, And this is why I tell them to bet £1 per 1,000 in their account. So if you have 5,000 pounds in your account, you bet £5 on those markets. £5, always the same amount. So if you have 10 grand, you bet 10 pounds. You see. So if you put a certain amount on the FTSE, you put the same amount on each call option. So all those positions must have the same amount. When they don't have the same amount, I mention it like 1/3 here. When I say 1/3, it means if normally you bet 10 pounds, here you have to bet 3 pounds. You see, 1/3. Okay, so I tell them exactly how they should bet so that their fund is safe. Okay, so if people are worried to lose money, or they don't like going through a large drawdown, because they can't sleep at night, or they get stressed, or whatever, this is a very good strategy because they will sleep well at night.
Yeah.
Because you can see that there are some positions that are covered. Like for example, this morning I went long the FTSE September 1/3 also to cover that cash. Okay, so the idea is that I'm expecting a rally later, okay, and I will close that September to go short again. and because it's not a very large position anyway, it's fine. But if the market was moving higher, I don't have a stop loss on that short position on the FTSE. I just put a stop loss on a long position on the FTSE. The reason why I do that is because we are not in a period where the FTSE will rally by 200-300 points. So I'm not worried about the market going up, by that amount. What I'm saying is more likely to crash. Okay. So if I was going along on a position and I didn't have any short to cover it, I would put a stop loss, because while I sleep at night, we don't know what can happen. Okay, but on the call option and there is no stop loss, because calls are very good instrument to trade because they have limited risk. Okay. So if I go to explain a bit about call options, the call, they go up with the market. It means that if the FTSE goes up, the call will go up, and also they have a maximum loss. And when you buy a call, your maximum loss is limited to the price you pay. Okay. So for example, if I buy a call like that call, 7550 call in July, it's 30 to buy, for example. If I buy it at 30, that is my maximum loss. 30 points is my maximum loss. So if I bet 10 pounds per point and I buy it at 30, my maximum loss, if I am wrong, is 300 pounds. This is my maximum loss. So you don't need a stop loss because it's like limited loss. Now, if I was going short, on a call, there is unlimited loss potentially, because it's the opposite. If you sell a call and the market goes up, that call will go up in value, and then you need to protect it. And what I do in that situation, if I was shorting a call and that call was going up and up and up, I would cover it with a long on the FTSE. This is what I would do. And this is why you can see some of the position in my account. They are short and long to protect each other. And that's why you see a mixture of short and long. But it's also to make the system safe for people. Okay. So basically, as I said, I think we are coming to the end of my presentation. I can see it's nearly 1 o'clock.
Yeah.
But what I was saying here is that this strategy, you get a lot of guidance from me. So you are not alone. You're not trading alone. Like, I've got some other system that people subscribe to, like straightforward trade alert on the FTSE with a stop loss, a price target, and people get on with it. But where this one is different, because I guide them every day. I tell them even how much they should bet, and what their position should be, so that it's not at risk. If the market crashes tomorrow, they are okay. You see, it's very much like kind of like having a mentor with them all the time. And then they can copy exactly, replicate my trade, But the idea of that strategy is that is focused on minimizing the risk that it is, and this is why I think many people, this is what they want. They don't want to trade with high risk. I know there are people who like risk because they can make a big return as well, but a lot of people, they ask me for this kind of strategy where they want to sleep well at night, without the worry.
Indeed, we all do. Thierry, do you have any performance statistics or any information really, just on terms of what?
Yes.
What
if people send me an email, I'll send them the performance.
Great. Now, where should the email? What's your email address?
Well, it's Thierry, Thierry.
Yeah.
At eyield.com, like the website.
eyield.com. Great. I'll just pop that email address out to everybody as well, so they can get because that's often something people want to see before they look at getting involved in some of these things. Well, Thierry, thank you very much for coming along. I know it was a fairly short notice for you, but you pulled together a very good presentation, and you've taught us a lot about Elliot Wave. It's something that we haven't actually focused on tremendously on this event before, so and I'm surprised, but thank you for coming along and starting that conversation. Definitely some people here do use the Elliot Wave or have looked at it and have been asking a lot of questions, which is great. So hopefully we can get you back again to sort of continue that that lesson. But in the meantime, there we are. The links are all there for people to go to the website, and they might want to come and join you in the community. It is just, as you say, you're focusing on the FTSE, so you're sort of specializing on that one index.
Yes, because this is where, you know, I understand the FTSE very well, more than other markets, and this is why I focus on it.
Good. I think that's good.
I think also, I think people can, you know, they can try that community for 2 weeks free. There is no charge for 2 weeks. This is a special offer for your clients, and they are welcome. Just complete the form, and then they can start the trial immediately.
Fantastic, guys. I've put the link in there for Thierry's. I'll just post that link again in case you missed it. It's just going in the text box now. It's eyield.com/special offers RTCT. Thank you very much indeed, Thierry. Thank you. We'll take the presenter role back because we're going to roll along now. We've got another speaker waiting to join us. But Sol, thank you for coming and giving us an hour of your time like that. Really appreciate it.
And thank you, Simon, for inviting me.
My pleasure. Speak to you again soon. Thank you very much.
Thank you. Goodbye, everyone. Bye.